Welcome guys, welcome to another episode of Mutual Funds की बात ICICI Direct के साथ. Today we have Radhika Gupta with us. Radhika is the CEO of Edelweiss AMC. Radhika, absolute pleasure to welcome you.
Thank you so much. Lovely to be here.
So before we move on with the questions of equity, we just wanted to know a bit about your journey. So could you just help us out with that?
Okay, so my journey is fairly straightforward. I have largely been a money management person. Grew up abroad. My dad was a diplomat, so spent the first 18 odd years of my life in various parts of the world, and then did my undergraduate degree in the US. Worked on Wall Street for 4 or 5 years. Came back to India, set up a hedge fund, actually the first registered hedge fund at that time, and sold it to Edelweiss, and then about 6 years ago became the CEO of the mutual fund business, and since then this is what I've been doing.
Okay, that was pretty brief.
Yeah. You said brief, so we're going to do brief.
Absolutely. So let's start with the first question. Today we see market are at all-time high, and you've been in this industry from quite a bit time. So you would have seen multiple cycles, multiple all-time high. And how, if somebody wants to get into the market and somebody wants to start his investment journey right now, how should one time it, or how should one allocate fund at this stage?
Okay, so I will answer the second part, but I have just two comments on market timing and this whole all-time high thing. Because I think investors are obsessed with the fact that markets are at an all-time high, and the reality is, in a growing country like India, where economic growth is expected to be what it is, you will continue to see all-time highs. So, there's not much to be read into the fact that we're at an all-time high. And it really doesn't determine what you should do. Second is this whole question of market timing. There are few things that I'm sort of very clear about in my career, and one of them is that most people, including often fund professionals, are very poor at market timing. Trying to time when the market is going to do well, when to invest, when not to invest is very complicated, and people do a terrible job of it because their emotions get in the way. I was talking to an investor 2 days ago about why I do SIPs personally with my own money, because I don't like to market time. And he was like, yeah, I stopped my SIPs when the Nifty was at 18,000 because I thought markets were expensive, and I was waiting for it to go to 15,000, and then it never happened, and now I'm at 20,000 and I didn't participate in the market. So I think trying to over engineer your investment strategy sometimes can be very difficult. So what is the advice in this market? One is that, look, if you're investing in equities, you have to have a time horizon.
Right.
And the time horizon is even more important when you're investing in markets that are not very cheap.
Yeah.
So if you were investing in markets that are very, very cheap, say like March 2020 of COVID, could you have a shorter time horizon and make money? Potentially. Yeah. Not that I advocate that. But when you're investing in these kind of conditions, it's very important to genuinely have that 7-year horizon on equities. The second is to take the kind of risk that you're comfortable with, because one of the things that's happening in this market in particular, it happens in all bull markets, is, sanity around risk appetite gets thrown out of the window. Yeah. Now, I love mid caps and small caps, but, someone came to me and said, I'm just going to put all my money into micro caps because they're going to rise 0.5% a day. And those are dangerous statements. Yeah. So it's important to realize that the past doesn't repeat, and also take the kind of risk that you are comfortable with. And I think if you do these two things right, if you get your asset allocation right and you have a reasonably long-term time horizon, you tend to be okay.
Okay, so my next question was here, because at this juncture, asset allocation becomes the key. Yeah. So someone who wants to get into the market right now, so what would be your ideal mix with regards to the asset allocation in terms of caps? Let's talk about large cap, mid cap, small cap.
Okay, so look, in terms of pure equity asset allocation, I think our lens has to change a little bit. Historically, most of us said, let's buy the Nifty, and it is enough. Yeah. Now, it's an interesting statistic, but in the late 90s, the average market cap of a large cap company was about 3,000 crores. Yes. The average market cap of a small cap company is 12,000 crores today. Caps have changed. Yeah. Once upon a time, we believed mid cap companies were small, poor corporate governance, just emerging companies. Today, market leaders in many segments are mid cap companies. So I truly believe that if you have to participate in India, your allocation should be broad-based. So you really need exposure to all three categories. That is large, which is large market leaders, proven business models, the next generation of giants, which is your mid cap, and your emerging stars, which is small cap. And the reason I feel so is, you want, if India's economy is going to grow, you are going to see all sectors lift up.
Absolutely.
And if you're looking for a leader in IT or financial services, you almost certainly have to look at large cap. But if you're looking for a leader in chemicals or paints or capital markets, you would have to look at a mid cap. And if you're looking for a leader in diagnostics, you would have to go for a small cap. Now, you can debate whether you should do 50% large, 25% mid, 25. I find this all very complicated. One solution that I really like is what I call dumb asset allocation. Just allocate equally to all three caps.
Okay, I think that would be a better strategy, because we can't have one fit all strategy.
It is really very difficult to get this timing right.
Yeah. So can you just speak about some funds that you have, like somebody like me who doesn't know about the markets and how to allocate fund? So any funds that you have at Edelweiss that we can tell about and
Sure.
we can look at?
So we have lots of funds, but let me talk about an upcoming fund and then an existing fund. So the upcoming fund that we have is, of course, the multi-cap fund, which I think is a dumb equity asset allocator, because it's effectively almost one third, all asset classes, large cap, mid cap, small cap, and I think that will be a very powerful construct. So that is just launching. Some of my other favorite funds, we run a large equity basket, and I love our mid and small cap funds. We've had a mid cap fund for more than 15 years and a small cap fund also for a reasonable amount of time. One of the things that we're very focused on is running the fund in a way that is true to label. So if we say mid cap, we hold mid cap. We don't want significant large cap exposure. Like, we don't buy a single large cap in our mid cap fund. So that's very important. We don't take cash calls. We don't take large macro calls. We know we are stock pickers and we do that well. So for people who want exposure to that segment of the economy, these are great funds: mid cap, small cap, and then of course upcoming multi cap. For conservative investors, the favorite fund in our basket has always been Balanced Advantage Fund. For a lay investor, I combine it and say that if dal and rice are two independent asset classes, this is khichdi that combines them all together. It has a blend of equity and debt, and the fund manager has the ability to allocate between equity and debt, and it really does a wonderful job for people who just want to fill it, shut it, forget it.
Absolutely. So viewers, if you want to see the funds, you can visit Edelweiss website or also on ICICI Direct's website, and can check out these funds and the the companies that they have put their money into. I want to come to the debt part, but there is one important event that is coming up. That is, there is a run up to 3 important state elections, and we have general elections next year. And usually during this time, we see market being a bit volatile, and people are generally wary of what may happen, which government may come. So what is your take, and how should one be prepared to digest this volatility around the election time?
So volatility around elections is normal, state less, general even more. And an evolved investor will realize that volatility is usually an opportunity. As long as you believe the long term is intact, volatility is an opportunity. If you don't want to call it an opportunity, then do nothing. I always say the minimum we can do in volatile times is not panic. Now, as far as elections, and I've been getting this question a lot, I don't want to make a political statement or say one government is better or the other. But fundamentally, what are we investing in? We're investing in companies that are growing with India's economic growth. India's economy has doubled every 6 years since 1981, incidentally, regardless of which government has been in power. So I think the country is in an incredible phase where GDP is going from $2,500 to $5,000 per capita. You've got this incredible young population, this demographic dividend, and that growth is sort of inevitable and will play out. So over the long term, I actually think you're well placed. I also think that I sometimes forget that while parties change or could change or will change, I don't know what it is, policy often, steps and reforms that started in one government are often continued by the other government, and that's the great thing about our nation. So I find all of this more of a cause for short-term drama, volatility, and a lot of media TRPs and fighting. But the reality I always say is the Indian economy is doubled every 6 years.
Absolutely. So you can bet on India rather than seeing the election or any party coming in. So my next question comes here that any sector that is on your radar which you prefer right now, and one sector that one should stay away. So two sector that you prefer and one to stay away. I'll keep it that way.
Okay, so I hate the sector question, even though I will answer it, because I do believe that, again, people spend a lot of time on sectoral analysis. And I think in a country like India, if I were to look at the next 10 years and I were to really look long term, I could tell you a story about manufacturing, and I could tell you a story about healthcare, and I could tell you a story about tech.
Yeah.
I could tell you a
Absolutely.
story about consumption. So really focus on finding good companies rather than obsessing about which sector. One side of the economy, which is more of a theme that we have been bullish on, is the whole revival or the emergence of India as a manufacturing giant. Historically, we have been a services-led economy led by IT services, which is a bellwether. But we do believe the animal spirits are going to kick into the manufacturing sector for a few reasons. More competitive tax, the PLI scheme, which is impacting a number of sectors, and the fact that the country today has one of the lowest wage costs in the world. So I think these three can come together to create a manufacturing boom and a manufacturing export behemoth. So this is one theme that we are, very optimistic on, and it has many sub themes. For instance, out of manufacturing comes defense. I always say that 30 years ago we would struggle to manufacture a toy, and today we can export fighter jets. So that's one theme that we're bullish on. You asked sectors that we are underweight on. Today we are underweight discretionary or consumer discretionary in some part. But I would again go back and repeat that if I wanted to take a truly decadal view, I wouldn't obsess with sectors.
Okay. So you spoke about the manufacturing sector. I just wanted to add one question there. There's this post the COVID, we had this China plus one strategy that came in. So what is your take on the China plus one strategy?
I want to say my take is a little balanced. So I think China plus one is a reality. And people are looking to diversify their supply chains outside China. I don't think China plus one only means India. And that's why I said it's a balanced take. So China plus one can also mean Mexico because of the proximity to the US. China plus one can also mean Vietnam and Indonesia because of the similarity of language. And China plus one can also be India. So I think we have a play in China plus one, but we are not the only play.
Exactly. But if we can blend that PLI and the China plus one, we can actually...
And I think the magic of PLI, and you're already seeing it in some sectors, is that we are being experimental and trying PLI in a number of different sectors. Now, in some places it will work out, and in some places it will not work out.
Absolutely. Exactly.
There's another interesting stat about PLI. I read somewhere that 75% of the jobs created by PLI in India have been occupied by women. That is incredible because we've always complained about labor force participation in India. And if you're truly adding more women into the formal economy, then that will have an incredible impact on GDP.
Yes, and there is a direct focus there. If you see DEI, there's a new focus that every company is also getting, diversity, equality, and inclusion. So that is one of, and ESG, which is the new thing which has come up, where you want to have participation and equal participation from women as well. So Radhika, we have spoken about equity, the sectors you are bullish on and sector one should be wary of. Let's move to debt, because since 2022, there was a lot of focus on the debt side because we saw the interest rate going up and someone can make good returns out of it. Plus the inflation thing that is playing out, which will have an impact on the equity market. What is your take on the debt side right now when we are almost ending 2023?
So I think firstly, I always believe that even in the best of equity times, debt serves a role in your portfolio, because I'm a firm believer in the power of asset allocation. So that is important because you need that cushioning to survive for the long term. How you take debt exposure, whether you buy debt funds directly, whether you do it through a balanced advantage or a hybrid fund, is a different question, but some amount of debt is usually valuable. As far as debt, I think we are at the top of an interest rate cycle. We don't believe rates are going to go down in a hurry. But we also believe some of the pain has passed us. I do believe debt asset allocation for customers should be very simple.
Okay. So if somebody is
Mhm.
here wanting to have a mix of equity, and I know I'm asking you a question which again is not one fit all strategy. If somebody wants to have a mix of debt and equity, so what would be your ideal
Oh
mix
God,
here?
it's so varied
I
depending
know
on who
that.
you are. But
Yeah.
I would suggest in today's tax regime, do it via a hybrid fund. So if you want a very aggressive equity portfolio and a little bit of debt, buy an aggressive hybrid fund. It's like 75-25 equity debt. If you want some mix, which is 60-40 on average, buy a balanced advantage fund.
Right.
If you want a conservative one, which is like 30 equity or 25 equity balanced debt, buy an equity savings fund. That's the most tax efficient way to do it.
Okay, so we have got three options here. So based on your risk appetite and what funds you can prefer, you can choose your mutual fund based on that. Okay. Moving on to my next question. This is for a fund manager. Like we are obsessed with buying, like what to buy, what
Uh,
to buy, what to buy. But the main aspect is about selling as well.
yeah.
Because if you do not sell at the right time,
Mhm.
you may lose that return, or you may not lock that return. So how do you decide to sell a particular script or something in your portfolio?
So I think, see, when we're looking at companies, what are we looking for? We're looking at one, companies that are fair to minority shareholders, companies that have inherent industry growth dynamics, and companies that are available at fair
Yeah.
valuation. Now, if one of these three things changes, obviously there's a change in management quality, fraud, etc. That's an immediate kind of thing. But you know, if you have reason to believe that growth is materially tapering off,
Yeah.
then you have a reason to talk about selling. If you have reason to believe that the stock prices become significantly more expensive and there is no further
Yeah.
appreciation, those are the typical triggers.
So basically, the valuation peaking out is one of the
Or,
main.
or the growth tapering
Yeah,
down.
absolutely. This I was reading about this new offering by Edelweiss. So
Yes.
can you just talk about STEP? I think it's your new offering, a
Yes.
new NFO offering. So could you just help us out with that as?
So the offering is the multi-cap NFO, as I
Okay.
talked about. STEP is a feature in this NFO.
Okay. Okay.
Now, when we were having a conversation, you asked me about volatility, elections,
Right.
state elections, and one of the concerns that people have investing in this market is, should I invest all in one go? So STEP is a way by which you say, I want to invest 100 rupees, but that 100 rupees will be deployed gradually at the end of the month or
Okay.
with certain triggers, which is market falls, over the next few months.
Okay.
So STEP is an offering that we're offering with our current NFO, so that investors can take a call. Do I want to deploy my 100 rupees right now, or do I want to deploy it in a staggered manner?
Okay. And if somebody wants to invest, he can invest it, right? Or is it live, or it is
So
about?
when the NFO opens, which is next month in early October, 4th of
Okay.
October, STEP will be open.
Okay, so viewers, you can definitely look at STEP, and we have already spoken about which fund to refer to or prefer according to your choice, and we already have an offering coming in as STEP, so
Yes.
you can definitely have a look
Yeah,
at
so
it.
you can look for STEP in Edelweiss multi-cap fund.
Absolutely. So, my next question is, there's a recent study saying that people do not hold mutual funds for more than, like I can say, 2.5 years is the average
Yeah.
period for people who are holding this. And when we started a conversation, it was about 5 to 7 years is
Yeah.
what you said. So one who's listening and one who has actually booked his mutual fund, what is your say to these guys who are booking it quite early?
God, I think I'm going to give you a funny analogy, even though I don't know if it's appropriate. But I once went to a single malt distillery, and they were showing me the process of making whiskey. And anyone who follows that asset class knows that value in whiskey, wine, etc., comes
Yeah.
from aging.
Right.
And they were telling me that the making process of whiskey is probably 10-15 days, something like that, mixing. And after that, whiskey sits in a cask.
Yeah.
And it acquires the flavor of the cask, it endures all seasons, and that's how exponential value gets created. And one of the distillers told me that until the substance has sat in the cask for 3 years, it doesn't even qualify to be whiskey.
Okay.
And I think the same is true of equity investing. Until you've given it a certain amount of time, it doesn't qualify to be,
Exactly.
because what are you doing? You're investing in companies, right? Now, I'm also the CEO of a business, and if you asked me, could I turn a business around in 2 years and show material, that's pretty unlikely.
Yeah.
So how do you expect your companies to do that?
Absolutely.
So give it time. And, I always say that compounding is a complicated word, but initially you are putting in capital.
Yeah.
Later, your capital and the returns on your capital are working for themselves.
Yeah.
And until you see that magic, you're not going to see the magic
Absolutely.
of equity investing.
It's just like setting up a new business where
It
you're
is.
putting up, you're doing your capex, and you are waiting for your return to come in. So viewers who are listening to us, please understand that 2 years, 3 years is not the right time to judge equity class for sure. You need to give it time, and an example of whiskey is the best example that one can see. Age like fine wine, and you can definitely make
It is
some.
like a malt.
Absolutely. Radhika, moving on. Since 2020, we have seen two eras, like pre-2020 era and the post-2020 era. Post-2020 era has been lured by this new thing. It has been around, but futures and options. And a
Yeah.
lot of people are moving towards options trading, because one, they get a high trading options, and two, they can make 10x, 20x. They are in that basically they're taking a gamble on their capital. So what is your say on this side?
So, firstly, I think SEBI released a study that talked about the fact that if you look at the aggregate of F&O traders, I don't think they make even FD returns.
Yeah.
And one can always look at ourselves selectively and say, but I will do better. But I think that is a powerful statistic versus the average FD, average Nifty investor
Yeah.
or average MF investor. I think MF equity investor has done substantially better than FD returns. So I think that's what the data says. Look, I think F&O it's a tool that was created for a specific purpose and a fairly sophisticated purpose. And it is unfortunate it has become an instrument of speculation or belief that this is easy money.
Yeah.
I don't believe there is easy money in this
Right.
business. I also believe that money that all of us earn is very hard earned.
Yeah.
And we work very hard for it. So let me give you a framework that may be a little more palatable. 80-90% of your diet, money, whatever, should be dal rice, home food, basic stuff, simple stuff. You want to do anything fun, please do it with the rest or the 10%. Because if I say stop F&O trading, nobody's going to believe me.
Absolutely. So it's like do simple things continuously.
Do simple things, and
yeah.
we don't like doing. And some of the largest HNIs in India, when you speak to them privately, they're like, after trying all the complicated products of the world, we decided to come back to the basics. I started my career trading mortgages in the US.
Okay.
People are, so I'm an investment professional जिसने हिंदी में कहता है ना घाट घाट का पानी पिया है in some way, right? The most complicated financial products. And people ask me, what's in your portfolio? What's in your portfolio? Mutual funds and SIPs.
Someone who has done MBS has mutual fund and
घाट घाट का पानी
exactly.
पी के exploring the whole world. I'm back to doing the basics.
Exactly. मैं उसी पे आने वाला था. I was supposed to come there because you have had an experience with the global financial crisis in 2008, and you have shared this publicly. So can you just, since we are on that part and the leverage part was also there, so could you just throw some light there?
Yeah, I
your
mean,
experience.
look, I've seen excesses out of the movies. And I do think a sense of balance on your shoulders is extremely important. Leverage is one of those things that can lead to the very end. That's the other thing that scares me about F&O as an asset class. So, use the capital that you have with the risk appetite that you have and do what you can with it.
Yeah.
Finally, ये जो पैसा है, money है, this should give you peace.
Right.
This should give you a better life.
Right.
It should not give you a high. I always tell young people, your career is probably the thing that should give you your high, or your family, or your child's laugh, etc. Beyond a point, how much high can an NAV give you, right? Yeah. I mean, I'm a mutual fund person. I'm telling you, beyond a point, how much high can an NAV give you?
Yeah.
So don't seek that in this. Money is there to solve a purpose. Finally, you're not going to sit and say, oh, your NAV was 11.4 and mine was 12. Nobody works like that, right? And the last thing money should do is cause you to lose sleep. And that's what one has seen so much of.
Yes. And there's a lot of people who have actually blown up their account and gone into
and those
massive
are heartbreaking
debt traps.
stories. They are of someone who took some father's retirement account, started doing F&O speculation. Those are heartbreaking stories. It should not happen to anyone.
Exactly. So big takeaway. Careful from leverage, and if you're doing futures and option, it should be from your 10% capital rather than your 90% capital. That's one of those.
Eating out too much is indigestion.
Yeah, absolutely. So Radhika, I think all my questions have been answered, but we all usually end our show with asking more about the guest. Like, what do you do when you're not looking at the market? And obviously, I want to know about Limitless as well, because I
Sure.
usually ask about books. So you have already written a book, Limitless,
Uh,
so you can just share a few things
yeah.
about Limitless. And
What do I do when I'm not looking at the markets? I have
yeah,
a 14-month-old, so I'm just playing with him,
okay,
which is really entertaining. He's just learned to walk, so you can imagine what he does.
yeah,
And so that's what I'm doing. About my book, yes, it's called Limitless. So it's published by Hachette, and uh, I always say it's a friend in most people's journey. That's what the book is meant to be. Uh, it talks about many of the issues and questions that I've encountered on my journey: comparison, rejection, risk taking, and it's a very Indian take on these issues because none of what I'm saying in that sense is
yeah.
new. But it's grounded in an individual's, in my own experiences and perspectives. And if anyone can learn anything from them, I'm more than happy. So please pick it up and read it.
Absolutely, absolutely. Thank you so much, Radhika. It was a pleasure hosting you. Thank you so much for taking time for us.
Thank you.
Thank you.
Please note, mutual fund investments are subject to market risk. Read all scheme related documents carefully.